When you think about global investing in 2026, you probably think about the United States, AI stocks, maybe India, maybe China. But what if one of the most interesting macro setups right now is Brazil? And not because of height, not because of a new tech boom, but because of something much more powerful: monetary policy, capital flows, and positioning. Today, I'm going to walk you through step by step why Brazil may be one of the cleanest macro rotation trades of 2026. Brazil is the largest economy in Latin America. It is a major exporter of soybeans, iron ore, oil, agricultural products. It's resource rich. It's large. It's systemically important. But for most of the past decade, it has been overlooked. Investors chase growth stories elsewhere, especially US tech and Asia. Brazil became under-owned. And that's important because sometimes the most powerful moves begin in markets that were ignored. For years, Brazil dealt with high inflation, political volatility, fiscal concerns, extremely high interest rates, and those high interest rates are the key. Brazil's central bank pushed rates to around 15%. That's one of the highest real interest rate environments in the world. High rates slow everything: borrowing, spending, investment, stock valuations. Brazil essentially ran one of the tightest monetary regimes globally. But now inflation is cooling, expectations have stabilized, and policymakers are signaling that rate cuts could begin as early as March. This is the pivot. When a country moves from peak restrictive policy into an easing cycle, equities often re-rate higher, especially in markets like Brazil where financial stocks are a large part of the index, credit demand matters, valuations were compressed by high rates. Falling rates change the entire dynamic. They support consumption, corporate earnings, credit growth, equity multiples. Brazil is moving from monetary pressure to monetary support. That's step one. Now layer in fiscal policy. Brazil recently implemented income tax reforms that will put more money directly into consumers' pockets. More disposable income means more spending, more demand, more domestic growth. So now you have falling rates, stable inflation, and fiscal support. That's a constructive domestic backdrop. Now zoom out. Emerging markets have begun outperforming the US in early 2026. Capital is rotating. Brazil-focused ETFs have already seen strong inflows. And yet, Brazil still represents less than 5% of major emerging market indices. That's important. This is not a crowded trade. It's early reallocation. And Brazil tends to perform well when global growth stabilizes, the US dollar weakens, capital moves back into emerging markets. Brazil is what we call a high beta market. When global flows turn, Brazil often moves faster. We're also in a world where trade relationships are shifting. Tariffs are being discussed again. Supply chains are realigning. Brazil has shown it can adapt. When exports to one region slow, it shifts toward others, particularly China. That flexibility matters in a world of geopolitical friction. Brazil is not dependent on one single trade channel. That resilience supports the macro story. So step back. Brazil today offers peak interest rates rolling into cuts, fiscal support boosting consumption, early capital rotation into emerging markets, undervalued positioning globally, strong leverage to global growth. In other words, Brazil isn't a story about catching up. It's a story about capital reallocating. And when large pools of capital reallocate, they don't move slowly. Now here's what makes this even more interesting. At Options Circle, we are spotting significant call options flow in Brazil-linked names. Investors are positioning with leverage for higher prices over the course of the year. That tells you this isn't just a slow macro allocation shift. There's active positioning building underneath the surface. Macro rotation, monetary easing, capital flows, and now leverage call buying. That's a combination worth paying attention to.